Let me begin by setting a clear frame for this conversation. This is not a discussion about charts, candles, price movements, or short-term market excitement. It is a discussion about wealth systems, financial infrastructure, and long-term positioning inside a changing global framework. If you are here looking for fast answers, predictions, or emotional reassurance, this talk may feel slower than what you are used to. But if you are here to understand how financial systems actually evolve and how certain assets become structurally relevant long before they become widely understood, then you are exactly where you should be. What most people miss in markets is not information, it is context. We live in a time where information is abundant, but understanding is rare. People scroll through headlines, watch price charts, react emotionally, and believe they are informed. In reality, they are often only seeing the surface of much deeper processes. And that brings us directly to today's title. Most XRP holders don't know this. Something meaningful has already happened. Not loudly, not dramatically, and not in a way that excites social media. It did not come with fireworks or hype. It happened quietly, structurally, and beneath the surface of price action. And because most people only watch charts, they missed it completely. Let me be very clear from the beginning. This discussion is not about convincing you of anything. It is not about telling you what to buy or sell. It is not about promises, timelines, or guarantees. This is simply an educational breakdown based on personal analysis and observation of financial systems, market structure, and institutional behavior. Nothing more and nothing less. When people think about markets, they are usually trained to look at price first. Charts, candles, and short-term movements dominate attention, and price becomes the main signal people react to. But in reality, price is almost never the starting point. Price is a reflection, not a cause. In every major financial system, infrastructure moves first, and price follows later, often much later. Understanding this distinction is essential for anyone trying to think clearly and calmly about long-term positioning. Infrastructure refers to the underlying systems that allow value to move. This includes payment rails, settlement mechanisms, legal frameworks, liquidity pathways, and institutional processes. These components are not visible to most participants because they do not create excitement. They create reliability. Banks, governments, and large financial institutions do not adopt new systems because they are popular or trending. They adopt them because those systems reduce friction, lower risk, and fit within regulatory boundaries. This work happens quietly through testing, integration, and gradual acceptance. XRP exists much closer to this infrastructure layer than many people realize. Its purpose is not to entertain short-term traders or generate constant headlines. Its design focuses on efficiency, interoperability, and the movement of value across complex financial environments. That positioning means progress is measured in compatibility and readiness, not in daily price movement. When people expect infrastructure to behave like a speculative instrument, frustration is almost guaranteed. Investor psychology plays a major role here. Humans are wired to seek feedback, and price provides immediate feedback. Infrastructure does not. This creates a psychological gap where silence feels like failure, even when meaningful development is taking place beneath the surface. Most people are not impatient because they lack discipline. They are impatient because they are watching the wrong indicators. They are observing surface-level motion while the real work happens deeper within the system. History shows that markets repeatedly misunderstand this phase. Roads are built before traffic increases. Networks are laid before usage explodes. Legal and technical alignment must exist before scale becomes possible. In finance, this process often looks slow, uneventful, and even disappointing to those focused only on outcomes. Yet it is precisely this phase that determines whether an asset or system can endure. Seeing infrastructure before price requires a shift in mindset. It means valuing placement over popularity, stability over excitement, and understanding over reaction. It means recognizing that large capital moves carefully, not emotionally, and that meaningful financial change rarely announces itself loudly. A calm investor does not rush to conclusions during quiet periods. They recognize that silence is not absence, and slow movement is not stagnation. By focusing on structure rather than noise, it becomes easier to remain steady, clear, and patient. In the long run, those who understand how infrastructure precedes price are better equipped to navigate markets with perspective rather than pressure, and with clarity rather than urgency. In financial markets, attention is often mistaken for importance. Assets that generate the most discussion, emotion, and visibility are assumed to be the most valuable or most successful. But history repeatedly shows that popularity is not the same as relevance. In many cases, the most influential systems operate quietly, away from public excitement. This is where the idea that placement matters more than popularity becomes essential, especially when thinking about long-term positioning. Placement refers to where something sits within a broader system. It describes how an asset connects to existing structures, how it interacts with institutions, and how it fits within regulatory and operational frameworks. Popularity, on the other hand, reflects short-term interest and emotional engagement. Popular things rise and fall quickly because attention is unstable. Placement is more durable because it is tied to function rather than feeling. XRP was not designed to compete for social approval or constant attention. Its role is centered on facilitating the movement of value within complex financial environments. That means its progress is more closely tied to system compatibility than to public enthusiasm. When an asset is positioned near financial infrastructure, its success depends on whether it integrates smoothly, not on whether it trends online. This often creates long periods where little appears to be happening, even though alignment is quietly improving. Investor psychology struggles with this reality. Many participants unconsciously equate visibility with progress. When something is discussed less, they assume it is losing relevance. But institutions do not evaluate assets this way. They look for stability, clarity, and operational fit. They are less concerned with narrative and more focused on whether a tool performs reliably under real-world conditions. This difference in perspective explains why institutional timelines often feel slow or confusing to retail observers. Financial history offers many examples of this pattern. Technologies that became foundational were rarely the loudest in their early stages. They succeeded because they were placed correctly within systems that mattered. Their impact became visible only after hay were already embedded. By the time the broader public noticed, the most important decisions had already been made. Understanding this helps reduce emotional reaction. If popularity is no longer the main signal, then silence becomes easier to tolerate. Progress can be measured by coherence rather than hype, by readiness rather than excitement. This shift in thinking allows for a more grounded approach to markets, one that values structure over noise, A long-term perspective requires accepting that meaningful financial roles are earned through positioning, not applause. When placement is strong, visibility eventually follows, but it arrives as a consequence, not a goal. By focusing on where an asset fits rather than how often it is mentioned, investors can remain calmer and more rational. In the end, patience is supported by understanding, clarity comes from perspective, and long-term confidence grows when popularity is no longer mistaken for importance. In financial markets, regulation is often misunderstood. Many participants view it as a limitation or an obstacle, something that slows innovation or reduces opportunity. In reality, regulation plays a very different role within large-scale financial systems. It does not exist to create excitement or momentum. It exists to create boundaries, clarity, and trust. This is why regulatory clarity enables institutions, not hype, and why it matters far more than most short-term market signals. Institutions operate under strict requirements. They manage other people's money. They answer to oversight bodies, and they must assess risk with precision. For them, uncertainty is not a challenge to overcome with optimism. It is a reason to wait. No matter how promising a technology may appear, large institutions cannot engage meaningfully until legal and regulatory questions are reasonably resolved. This is not hesitation. T is discipline. Regulation provides the framework that allows participation without exposing organizations to uncontrolled risk. XRP sits within this reality. Its relevance is closely tied to how clearly it can function within existing legal and financial structures. Progress in this area is rarely dramatic. It happens through court decisions, regulatory guidance, compliance standards, and gradual alignment with institutional expectations. These developments do not create emotional reactions because they are technical and procedural. Yet they are foundational. Without them, integration at scale is simply not possible. Investor psychology often clashes with this process. Many market participants are conditioned to respond to excitement, headlines, and momentum. Regulatory clarity feels slow and uninteresting by comparison. When there is no immediate emotional payoff, it is easy to assume nothing of value is happening. But from an institutional perspective, clarity is the signal. It reduces uncertainty, enables modeling, and allows long-term planning. Hype may attract attention, but it cannot support sustained participation. Financial history supports this pattern. Markets mature not when speculation peaks, but when rules become clearer and behavior becomes more predictable. The transition from uncertainty to structure is rarely celebrated, yet it marks the point where systems can expand responsibly. This is the stage where serious capital begins to observe more closely, not because opportunity is louder, but because risk is better defined. Understanding this helps reset expectations. Regulatory progress should not be evaluated by how it feels, but by what it allows. It does not promise outcomes or timelines. It simply opens doors that were previously closed. For assets positioned near financial infrastructure, this matters far more than short-term popularity. Teddy approach recognizes that institutions move when conditions are suitable, not when narratives are persuasive. Clarity precedes confidence, and confidence precedes scale. By viewing regulation as an enabler rather than a trigger for excitement, it becomes easier to remain patient. In the long run, clear rules support durable systems, and those who understand this can maintain perspective, reduce emotional noise, and focus on long-term clarity rather than short-term reaction. Financial systems do not move at the speed of emotion. They move at the speed of coordination. This is one of the most difficult truths for market participants to accept, especially in an environment shaped by instant feedback and constant information. System timelines reward patience, not emotion, because complex financial structures require alignment across technology, regulation, institutions, and behavior before meaningful progress can occur. In the early stages of any financial innovation, activity appears slow and uneven. There are periods of testing, adjustment, and reassessment that rarely produce visible results. From the outside, this can look like indecision or stagnation. In reality, it is a necessary phase of system development. Large financial systems cannot afford to move quickly based on enthusiasm or public pressure. They must move correctly. Speed without coordination introduces risk, and risk is the one variable institutions work hardest to minimize. XRP exists within this kind of system-level environment. Its intended role connects it to payment infrastructure, compliance frameworks, and cross-border processes that are already complex and highly regulated. Progress within such systems does not follow market cycles or emotional narratives. It follows institutional calendars, legal milestones, and operational readiness. This creates long periods where little seems to change, even though foundational work is ongoing. Investor psychology often struggles during these periods. Humans naturally look for signals that confirm momentum. When those signals are absent, doubt and frustration emerge. Emotional reactions then fill the gap left by a lack of visible progress. This is not a personal failure, it is a common cognitive response. But when emotion becomes the primary lens through which system-level assets are evaluated, perspective is lost. Short-term feelings begin to override long-term structure. History offers consistent lessons here. Financial infrastructure has always evolved more slowly than public expectations. Settlement systems, payment networks, and regulatory standards have taken years, sometimes decades, to mature. The benefits only became obvious after the systems were already in place. Those who judged progress based on immediate outcomes often underestimated the eventual impact. Understanding system timelines requires a different way of measuring progress. Instead of asking what is happening today, it asks whether alignment is improving over time. Are legal frameworks becoming clearer? Are institutions becoming more comfortable? Are processes becoming more efficient and standardized? These are quiet indicators, but they are reliable ones. Patience in this context is not passive, it is informed. It comes from recognizing that silence does not equal failure and that slow movement does not imply lack of direction. Emotion thrives on uncertainty, while patience grows from understanding. When expectations are aligned with how systems actually evolve, emotional swings lose their power. A long-term perspective accepts that meaningful financial change unfolds gradually and often without public attention. By respecting system timelines, it becomes easier to remain calm, focused, and clear. In the end, those who allow patience to guide their thinking are better equipped to navigate complexity, maintain perspective, and approach long-term positioning with confidence, rather than emotional urgency.